Have you ever heard people talk about bonds and wondered what they are? You often hear about stocks and bonds in the financial world, but while stocks are well known, bonds can seem more mysterious. In simple terms, a bond is a type of loan, but instead of you borrowing money from a bank, you are the one lending money to a government, a company, or an organization. Here is how it works. Imagine a government needs money to build new roads or schools. Instead of raising taxes right away, it can issue bonds. Investors buy these bonds, which means they are lending money to the government. In return, the government promises to pay the investors back on a certain date, called the maturity date, along with regular interest payments in the meantime. Companies can do the same thing. If a business wants to expand or build a new factory, it might issue bonds to raise money instead of taking out a bank loan. When you buy a bond, you are not becoming an owner like you would with stocks. Instead, you become a lender. This is an important difference. Stockholders share in the profits of a company, but also face more risk if the company does badly. Bondholders, on the other hand, have a more secure agreement. They get fixed interest payments, called coupon payments, and the promise of getting their money back at the end of the bond's term. So, why do people invest in bonds? One reason is safety. Bonds are generally considered less risky than stocks because they provide regular income and repayment at maturity. Governments, especially stable ones, are usually very reliable borrowers, which makes their bonds quite safe. Another reason is stability. Investors often use bonds to balance out riskier investments, creating a safer mix in their portfolios. However, bonds are not completely risk-free. One risk is default, which means the borrower may not be able to pay back the money. While this is rare for strong governments, it can happen with companies or weaker economies. Another risk is inflation. If prices rise quickly, the fixed interest from a bond may not keep up with the cost of living. Finally, there is interest rate risk. If new bonds are issued with higher rates, the value of older bonds with lower rates can drop in the market. Bonds also play a big role in the economy. They allow governments to fund public projects without raising taxes immediately. They give companies a way to grow and expand without giving up ownership. At the same time, they provide investors with a steady income and a safer place to put their money. To sum it all up, a bond is simply a loan that you, as an investor, give to a government or a company. In return, you receive regular interest payments and your money back at maturity. Bonds offer safety and stability compared to stocks, but they also come with risks like default, inflation, and changing interest rates. Thanks for watching. And if you found this explanation helpful, remember to like, share, and subscribe for more.